Welcome to the Deep Dive, the show where we take your pile of sources and distill them into actionable insights, making you feel instantly well-informed. Today, we're plunging into a story that has captivated financial markets and, beauty enthusiasts alike, the dramatic fall, a potential rise of a luxury beauty giant. Imagine a company that was once a market darling, an undisputed titan of prestige, suddenly facing a, staggering 80% drop in its stock price, and now finds itself in the midst of a high-stakes, deeply scrutinized turnaround effort. We're talking, of course, about Estée Lauder. You might even recall whispers that one of the most famous deep value investors, Michael Burry, of the Big Short thing, the man who called the housing crash, he apparently had Estée Lauder as his single stock bet in a recent portfolio, a true contrarian play, right?
Yeah.
Absolutely. What's truly fascinating here is not just the sheer scale and legacy of Estée Lauder, name synonymous with luxury for generations, but the sheer complexity of its challenges. This wasn't a slow decline. It was, like you said, a perfect storm, a convergence of macroeconomic shifts that rocked global markets, profound changes in consumer behaviors that reshaped an entire industry, and frankly, some critical internal missteps that proved almost catastrophic. So our mission today is to unpack this intricate situation, examine with clear eyes what exactly went wrong and why it hit so hard, and then critically assess the ambitious, multifaceted strategies the company is now deploying to reclaim its former glory. We'll delve into the hard numbers, the strategic pivots, and even some of the boardroom drama that unfolded behind the scenes. By the end of this deep dive, you'll have a clear understanding of whether Estée Lauder is truly poised for a rebound, or if it's still facing an uphill battle that might prove too steep, even for a brand of its stature.
Okay, let's unpack this. You've provided us with a stack of insights from financial analysts, company reports, and even some fascinating historical context that paints a much richer picture. So let's start at the beginning, before the storm. What exactly is Estée Lauder at its core, and how did it become such an undisputed powerhouse in the first place? So before its recent struggles, Estée Lauder was, and it still is, a leading prestige beauty conglomerate. For those of you who might not realize the sheer scale, they were founded way back in 1946 by Josephine Esther Mensah, who later became Estée Lauder. A true visionary, really, started with just 4 products and an unwavering belief in the power of beauty. Today, they sell products in about 150 countries, reaching virtually every corner of the globe where luxury beauty is desired. And it's not just the Estée Lauder brand itself, right? We're talking about an umbrella of over 20 distinct brands, many of which you likely recognize or even use in your daily routine, like Clinique, MAC, Bobbi Brown, La Mer, the ultra-luxury skincare darling, Aveda, Jo Malone London, and Tom Ford Beauty, just to name a few of the crown jewels in their vast portfolio. And when you really dig into the revenue breakdown, you discover that skincare isn't just a part of their business. It accounts for the lion's share, about 51% of their revenue. Makeup falls at a significant 28%, with fragrances making up 16% and hair care a smaller 5%. This product mix, especially the dominance of skincare, is absolutely crucial for understanding both their historical strengths, like higher margins and recurring purchases, and their recent vulnerabilities when specific markets faced these unprecedented shocks.
That's a crucial point. What's truly fascinating here is that historically, the company grew predominantly through an incredibly astute strategy. They were amazing at identifying small, emerging, often niche brands, and then leveraging their global distribution and marketing power to scale them into international giants. They have been exceptionally good at this, almost like an incubator for beauty brands. This strategy allowed them to continuously diversify their product portfolio and appeal to a wide array of customer segments, from the most discerning luxury buyers to innovative, developing brands capturing new trends. Think of significant additions like Too Faced, a makeup brand aimed at a younger demographic, or Dr. Jart plus a pioneering K-beauty brand, and the acquisition of the entire Tom Ford brand, which brought high-fashion luxury right into their fold. This expansive approach even extends to their internal categorization. They meticulously manage brands across segments like luxury, large established brands, scaling brands with high growth potential, and developing brands that are new and experimental. Some, like Tom Ford, impressively belong to multiple categories. It's both a luxury powerhouse and a brand they're still scaling aggressively. This diversification was always intended to mitigate risk and capture various market segments, offering a robust portfolio against market whims. Yet, as we'll soon see, even this sophisticated strategy didn't completely shield them when a truly perfect storm hit.
And it's clear this strategy worked for a very, very long time. For decades, Estée Lauder was, in financial terms, a compounding machine, just churning out returns. We're talking about a company that consistently delivered compounding earnings per share by an impressive 13% annually between 2005 and 2022. all while generating enviable returns on capital in the mid-20s. This wasn't just a good business. It was a juggernaut, a high-quality company that analysts and investors adored. At its peak in 2021, the company was valued well north of $100 billion, with its stock hitting highs close to $400 a share. Can you imagine? This was a business that seemed to defy gravity, almost immune to economic cycles, driven by aspirational purchases and a growing global middle class. But then, as we know, things took a sharp and, frankly, brutal turn. The stock plummeted by about 80% from those highs in a shockingly short period. So after such an incredible run, what exactly went wrong to cause such a dramatic reversal? What pulled this beauty empire back down to earth with such force?
Well, if we connect this to the bigger picture, the downturn was, as you said, a perfect storm. But the eye of that storm, without a doubt, was China. Estée Lauder had made substantial strategic investments in the Asia market starting around 2010. This wasn't a casual entry. They went all in, establishing a $1 billion manufacturing facility in Japan, opening a cutting-edge innovation center in China, building a sophisticated distribution facility in Switzerland, all strategically aimed at capitalizing on China's booming premium beauty market and supporting global travel retail, which was massive. This aggressive, forward-looking approach proved exceptionally effective. It enabled the company to capture a substantial market share and led to an astonishing 400% stock increase in just 7 years. They truly bet big on China, and for over a decade, it paid off handsomely, making China the single most important growth driver for the entire enterprise.
Right. Here's where it gets really interesting, because that growth engine, which had propelled them for so long, suddenly sputtered and then completely seized up. Then the pandemic hit, and everything changed. Chinese tourism and global travel retail, which were massive channels for luxury beauty, just came to a grinding halt. But more damagingly, even after COVID restrictions eventually lifted, Chinese consumer spending didn't rebound as expected. It wasn't just a delay, it was a profound shift. A shift in consumer confidence and priorities. By some estimates, a staggering 93% of Estée Lauder's recent sales decline is traceable directly to Chinese consumers. That's an incredible level of concentration, essentially putting nearly all their eggs in one very specific and temporarily fragile basket. It just shows how reliant they had become on that one market, a reliance that proved to be their Achilles heel.
Indeed, and a critical, perhaps underreported element that amplified this crisis was the collapse of the Daigou gray market channel. For listeners unfamiliar, Daigou involved Chinese travelers or professional shoppers buying duty-free cosmetics in places like Hainan, South Korea, or even Europe, to then resell those products back home in mainland China. They could offer these products at a markup from the duty-free price, but still significantly below the official mainland retail prices, often avoiding import duties. This unofficial channel was enormous, estimated globally at a staggering $81 billion. And before COVID, it significantly boosted Estée Lauder's revenue and, critically, its margins. Duty-free sales are highly profitable, you see. When international travel stopped dead during the pandemic, this entire ecosystem just collapsed overnight. Gone. And just as travel was tentatively resuming, China's government, recognizing the lost tax revenue and wanting to bring more of this trade onshore, cracked down decisively on Daigou reselling in 2023. To illustrate this, China had introduced a pilot policy back in 2011 to boost domestic tourism and encourage spending at home, especially in Hainan. Hainan's a beautiful tropical island that became a duty-free haven. It was a boon for consumers and brands initially. But by 2023, with Hainan popular enough as a legitimate travel destination, the government tightened regulations on Daigou, effectively cutting off one of Estée Lauder's most important, albeit unofficial, sales levers. This reliance on Daigou also meant that less travel and stricter border controls affected luxury sales from Chinese tourists in Europe and the US, contributing to declines there, even if the numbers didn't initially look as solely China-dependent. It truly became a perfect storm of external and policy-driven factors that expose a deeply ingrained vulnerability.
So if I'm understanding correctly, the company had not just many, but most of its eggs in one very profitable basket, and then that basket essentially disintegrated, leaving a gaping hole. But the sources suggest there were also issues with management transparency and communication, which only exacerbated the problem for investors who were trying to understand the depth of the crisis. What was going on there, particularly with what investors were being told? How did that impact confidence?
Yeah, this raises an important question about corporate governance and the critical importance of transparent communication, especially in a crisis. The management's transparency record during this period was, frankly, mixed and proved costly. For example, as late as fall 2022, Then CEO Fabrizio Fredo was still publicly forecasting a solid rebound in China, painting a picture of recovery that, regrettably, didn't materialize. This forced an abrupt and quite jarring U-turn in guidance in spring 2023, which dramatically impacted investor confidence. You could see it in the stock price. This perceived misdirection, or at least misjudgment, eventually led to a shareholder lawsuit in early 2024. The lawsuit alleged that Estée Lauder had defrauded investors by massively understating its exposure to the Chinese gray market, despite internal reports indicating that a dedicated team within the company was actively analyzing Daigou sales, suggesting a potential disconnect between internal knowledge and external communication. This lack of transparency, or at best an overly optimistic public narrative, really eroded investor trust when the harsh reality eventually hit.
Wow. And it wasn't just about the numbers in investor relations. There was even some high-level family drama brewing that sounds straight out of an HBO series, like Succession, almost. We've heard about boardroom battles at other companies, but here, Jane Lauder, a significant shareholder and the founder's granddaughter, reportedly called for her cousin William Lauder's ouster from his executive chairman role. This wasn't a quiet internal negotiation. It apparently reflected deep, almost existential disagreements over strategic direction, the severity of the crisis, and who was best equipped to navigate it. This internal tension and fight for power, a true drama playing out in real life, eventually led to multiple management changes, and the appointment of a new president and CEO, Stéphane de La Faverie, in January 2025. It's a truly remarkable historical moment, as it marked the first time in almost 80 years that no Lauder family member held an operational title at the company. It signaled a profound shift, a recognition that perhaps external, fresh perspectives were needed to navigate this unprecedented storm and steer the brand back to stability.
Absolutely. And beyond the China focus, the Daigou collapse, and the internal dynamics, the very financial heartbeat of this once unshakable giant took a catastrophic hit. Imagine a company that had consistently delivered for decades, suddenly seeing its overall financial health deteriorate significantly. In fiscal 2025, overall revenue was down a painful 8%, and adjusted operating income contracted by an even more alarming 28%. Let's look at the product categories. Skincare net sales, their largest segment, decreased 12%. Makeup decreased 5%, and hair care decreased 10%. Only fragrance managed to remain flat, which, while not growth, was a relative success amidst the declines. The severe demand shortfall, especially in Asia where their products were flooding in just as demand evaporated, led to an immense pileup of excess inventory in warehouses. These high-value cosmetics risked going unsold or becoming obsolete. You can't just sit on that stuff. This forced heavy discounting, particularly in prestige skincare, where brand exclusivity and pricing power are absolutely crucial. This discounting significantly weakened margins, hurting the very perception of luxury they had cultivated for so long. Adjusted earnings per share, a critical measure of profitability, plummeted from a robust $7.24 in fiscal 2022 to a mere $1.51 in fiscal 2025. A huge drop. Gross margins, which were historically strong at 78% at peak, attesting to their brand equity, were severely impacted by these inventory issues and the need to clear stock.
And if that wasn't enough to contend with, some of their strategic acquisitions, which used to be their undisputed strong suit and growth engine, also faltered significantly. They paid $1.45 billion for Too Faced, a popular makeup brand, in 2016, and $1.1 billion for Dr. Jart plus Sayer, a pioneering K-beauty brand, in 2019, expecting these to be future growth drivers. Yet, both struggled, leading to massive impairment write-offs, which, for you listeners, is an accounting term meaning they had to formally reduce the value of these acquired assets on their balance sheet, because their expected future earnings and performance from them were significantly lower than initially anticipated at the time of purchase. It's basically admitting the deal wasn't worth what they paid. We're talking approximately $800 million for Dr. Jart Plus and another $773 million for Tom Ford, which they had only recently acquired for roughly $2.8 billion in 2022. These weren't just bad investments, they represented a significant erosion of shareholder value. A lot of money down the drain.
The company also faced multiple lawsuits, including a $159 million settlement for talcum litigation, where some talc-based products were alleged to contain asbestos, and the ongoing shareholder suit about China exposure we mentioned. These legal and financial hits just added to the immense pressure from every direction.
Furthermore, to compound the financial strain, the company's long-term debt more than quadrupled in the last decade. Quadrupled. reaching $7.28 billion by fiscal 2025, largely due to these very same acquisitions. Debt isn't free, it costs money to service. This rising debt, combined with decreasing revenue and flat cash flows, put significant stress on their financials, limiting their future flexibility for reinvestment or further strategic moves. Even their share buybacks in 2021, executed near the stock's all-time high, can be viewed in hindsight as questionable capital allocation. At a time when the company was already heavily dependent on the Chinese market and its gray channels, buying back stock at peak valuations demonstrated a potential misalignment between capital allocation decisions and the underlying, increasingly fragile market realities. It really felt like a perfect storm hitting a financially constrained ship.
So you've painted a clear picture of the internal missteps, the China-specific challenges, and the financial wreckage. But I can't help but wonder if Estée Lauder was already facing a slow-burning crisis due to broader shifts in consumer tastes, even before these specific fires erupted. What were the underlying currents changing the very definition of prestige beauty that also contributed to Estée Lauder's woes? Because it can't be all about one region or a few bad deals, right? There must have been something else brewing.
Absolutely. You've hit on something vital there. This raises an important question about evolving consumer preferences and the dramatically increased competition from new agile players. Younger consumers, in particular, have shown a pronounced shift away from traditional brand prestige, where a brand name alone was often enough, towards functionality, ingredient transparency, and authenticity. They want to know what's in it, how it works, and who made it. It's a different mindset. Indie brands and influencer-led products like Rare Beauty by Selena Gomez or Makeup by Mario are capturing the zeitgeist precisely because they speak directly to these values, often with more direct, digital-first marketing that resonates. It's increasingly difficult for legacy premium brands to differentiate when consumers prioritize substance over brand name, especially when, as our sources indicate, R&D spend for Estée Lauder was a mere fraction of its marketing spend, almost 10 times lower. This stark imbalance suggests that, for a period, they may have prioritized maintaining a perception of innovation and glamour over genuinely investing in the scientific breakthroughs and product differentiation needed to stay ahead. A strategy that became unsustainable when the market demanded substance over celebrity endorsement. And in China, this trend was amplified by the significant rise of C-beauty homegrown Chinese brands like Florasis or Perfect Diary. These brands don't just compete on price, they brilliantly leverage digital marketing, tapping into a burgeoning sense of national pride. Offering products often tailored specifically to Asian skin tones, climates, and cultural beauty ideals, and incorporating traditional Chinese aesthetics into their packaging and storytelling. This cultural resonance and agility is a competitive advantage that Western brands with slower global product cycles struggle to match. Dr. Jart Plus A, for instance, was an attempt to enter this space, but even it struggled with lower than expected results in Korea and mainland China, demonstrating the difficulty of integrating and scaling such brands in a rapidly changing, highly localized market. It's a bit like how craft beer emerged to challenge the big brewers, you know? These smaller, agile Chinese brands, with their cultural storytelling and hyper-specific formulations, resonated by tapping into local pride and unmet needs that the global giants simply couldn't match at speed or with the same authenticity.
It sounds like a perfect storm of external and internal pressures that left Estée Lauder reeling, truly battered from every side. The numbers were grim, investor confidence was shattered, and the company's very identity seemed at risk. But as with any compelling story, the nadir often precedes the rebirth. Estée Lauder wasn't going to simply fade away. Instead, under new leadership, they've embarked on a dramatic, high-stakes mission to claw their way back. A complete overhaul designed to reclaim their former glory. So what's the blueprint for turning this colossal ship around? What's the actual plan? Stepping into this incredibly challenging environment is the new president and CEO, Lefebvre, who officially took the helm in January 2025. He's not just an outsider. He's a cosmetics industry veteran, having spent over a decade at Estée Lauder in various leadership roles and even prior experience at L'Oreal. So he knows the business. He's laid out an ambitious, multi-pronged plan. The core of this turnaround involved two major initiatives that are tightly intertwined: the Expanded Profit Recovery and Growth Plan, or PRGP, and a brand new forward-looking strategy called Beauty Reimagined. This is a complete overhaul, not just a few minor adjustments. It's a fundamental reimagining of how they operate, innovate, and connect with consumers.
That's a crucial distinction. The PRGP, initially launched in late 2023, was first intended as a 2-year initiative focused on improving efficiency and aggressively cutting costs. However, as revenues continued to decline and the depth of the crisis became clearer, the plan was significantly expanded in scope and ambition. It now projects substantial restructuring charges between $1.2 billion dollars and $1.6 billion dollars before taxes, which includes the painful but necessary decision to implement 5,800 to 7,000 job cuts globally. These are undeniably tough, decisive steps, reflecting the seriousness of the situation. The good news, though, is these actions are expected to yield substantial annual gross benefits of $7-8 billion to $1.0 billion. These savings are absolutely crucial for two reasons. Firstly, restoring operating margins, which have been severely eroded, and perhaps even more importantly, funding vital reinvestment into consumer-facing areas, the very places they need to be competitive again. This is about making the business leaner and more efficient so it can afford to be more aggressive and innovative in the market.
So the company is cutting deep to rebuild, essentially performing major surgery to stabilize the patient. And it seems they've been making tangible headway, which is a positive sign for investors, right? They actually over-delivered on the PRGP in fiscal 2025. We saw adjusted gross margin expand by 230 basis points to 74.0% despite continued sales volume declines, which shows the efficacy of their operational changes. It's working, at least on the cost side. This improvement came primarily through operational efficiencies, a reduction in excess inventory, and a decrease in promotional discounting. They also prudently reduced non-consumer-facing expenses by 6% to help fund those crucial consumer-facing investments. This demonstrates that the initial difficult cost-cutting measures are starting to flow through to the financials, providing much-needed breathing room and a foundation for future growth.
Right. And complementing the PRGP is the Beauty Reimagined strategy, which began in February 2025. This is a far more forward-looking plan built on 5 distinct pillars, all designed to reignite growth and adapt the company to the new beauty landscape. The first pillar is to accelerate best-in-class consumer coverage. This means meeting the customer wherever they are, not just in traditional department stores, and aggressively expanding into faster-growing, digitally native channels like TikTok Shop and Amazon's premium beauty stores. For instance, in fiscal year 2025, they launched an impressive 11 brands on Amazon in the US and 3 brands on Amazon.ca in Canada. That's quite a move. They also significantly expanded their online distribution in Southeast Asia, launching 14 stores on Shopee and 4 on TikTok Shop, recognizing the immense power of social commerce in that region. Even specific brands like The Ordinary expanded their footprint into new markets like Thailand, mainland China, Turkey, and Brazil. They're also strategically expanding freestanding stores for their ultra-luxury fragrances like Le Labo and Jo Malone London, catering to experiential retail. The CEO noted that Amazon, traditionally not seen as a luxury channel, is acting as a megaphone for their total business, attracting both new and lapsed consumers who are increasingly starting their beauty searches online. Interesting perspective.
That's a smart, pragmatic move, getting into where the younger consumers are spending their time while also expanding the reach for existing luxury brands in a targeted way. But while distribution is key, the second pillar really hits at the heart of the C-Beauty challenge we discussed, creating transformative innovation. This isn't just about launching a new lipstick shade. It's about speeding up development cycles dramatically and tailoring products for very specific regional needs. It's a direct response to the agile, localized competition, isn't it? They're collaborating with prestigious institutions like MIT and have opened a biotech hub in Belgium to create sustainable, high-profit products and deliver fast-to-market, on-trend innovations that are genuinely relevant to diverse consumer bases. This aims to shift the focus from just marketing existing products to genuine, responsive product development that anticipates and creates trends. More substance.
And that leads directly to the third pillar: boost consumer-facing investments, which is a critical and welcome shift in capital allocation strategy. They're significantly increasing visible advertising, optimizing marketing programs for maximum impact, and ruthlessly eliminating low-return activities. Critically, this means moving away from the past strategy of investing heavily in fixed assets like factories ahead of growth, which proved problematic when that growth didn't materialize. Remember those big facilities? Instead, they are now channeling that precious capital into media platforms and promotions to acquire new consumers and reignite interest in their existing portfolio. Smart. The fourth pillar, fuel sustainable growth through bold efficiencies, leverages the expanded PRGP savings we just discussed. These savings aren't just for shoring up the balance sheet. They are strategically earmarked to fund these crucial consumer-facing investments, creating a virtuous cycle of efficiency and growth. Finally, the fifth pillar, Reimagine the Way We Work, is about removing complexity, simplifying processes, and empowering faster decision-making through a flatter, more agile organization. This includes aggressively utilizing AI with partnerships like Microsoft AI at Work and Adobe Firefly to drive operational efficiencies. In areas like creative workflows, personalized marketing, and supply chain processes, aiming for both speed and precision in a modern era. But, while utilizing AI and simplifying processes sounds efficient, the true reimagining here involves a massive cultural shift across a global organization. Moving from potentially siloed departments to empowering faster decision making requires not just new technology, but a willingness to shed ingrained habits, embrace agility, and foster a new mindset among thousands of employees. This is often the hardest part of any turnaround, changing the very operational DNA of a company. It's not just flipping a switch.
It sounds like a truly fundamental overhaul, not just a few tweaks around the edges. They're reevaluating everything from product development and distribution to how they spend their money and how their entire organization functions. And one clear, albeit often unpopular, sign of their commitment to this turnaround is a decision rarely welcomed by investors. They cut their dividend. After consistent dividend growth since their IPO in 1995, a testament to their stability, they reduced their quarterly dividend to 35 cents per share in fiscal 2025. While often seen as a negative signal, some astute analysts view this as a necessary and appropriate step, a pragmatic decision maybe, to free up vital capital for reinvestment into growth and to strengthen the balance sheet rather than maintaining an unsustainable payout that would compromise their future. It's a tough call, but one that signals a focus on long-term health over short-term gratification.
Right. And to further enhance accountability and streamline operations, Estée Lauder has also reorganized its geographic regions, effective fiscal 2026. Instead of the previous structure, which perhaps wasn't capturing the unique nuances of certain markets, they will now report under four new, more distinct regions. The Americas, covering North and Latin America, UKEM, Europe, UK, Ireland, and Southeast Asian emerging markets. Asia Pacific, a broad region including global travel retail, and critically, mainland China, which is now a completely separate region. This restructuring reflects their strategic priorities and a clearer segmentation of their global business, acknowledging the distinct dynamics and immense importance of the Chinese market by giving it its own dedicated reporting structure and focus, rather than burying it within a larger Asia segment. It's a clear signal that they understand where their biggest challenges and opportunities lie, zeroing in on China.
Okay, so with all these dramatic changes, the deep cuts, the ambitious new strategy, the leadership overhaul, the big question for you, our listener, is, are these strategies working? Are there any early signs of a rebound, or is it simply too soon to tell? We've seen a lot of plans, but what about the actual tangible results on the ground?
That's the million-dollar question, isn't it? And thankfully, yes, there are encouraging early signals, though it's important to remember that a turnaround of this magnitude is still very much in its initial stages. It takes time. In mainland China, for instance, where the biggest problems originated, they continued to gain prestige beauty market share in Q4 fiscal 2025. Across every category and channel, led by powerhouse brands like La Mer and Tom Ford, that's significant. They also achieved top ranks during key shopping festivals like 11 and 618 across major platforms like Douyin, JD, and Tmall. For brands such as Estée Lauder, La Mer, Jo Malone, and MAC, they're winning in those big moments. Retail sales showed mid-single-digit growth in the second half of fiscal 2025 in China, with early signals of continued market share gains even into July 2025. This stabilization and growth in China after such a dramatic decline is a very positive development and speaks to the targeted efforts.
That's a huge shift from where they were, especially considering the catastrophic impact China had on their previous performance. Huge. And it's not just China showing signs of life. In Japan, they gained market share every single quarter of fiscal 2025 and strengthened their #1 rank in the fragrance category, thanks to the continued success of luxury brands like Le Labo and Jo Malone London. Even in the U.S., a mature market, they made significant improvement, gaining share in the second half of fiscal 2025, driven by the impressive growth of The Ordinary, Clinique, and the core Estée Lauder brand, with those new Amazon launches clearly contributing to broadened reach. And remember the Daigou channel issues, which had been such a major drag, they even turned positive in Henan in May 2025, showing that the renewed retail activities and direct engagement are finally starting to pay off in the crucial travel retail segment. These are all promising data points, suggesting the multi-pronged strategy is starting to gain traction in diverse, vital markets.
Building on these early successes, the company's outlook for fiscal 2026 is cautiously optimistic. Cautious, but optimistic. They are affirming expectations for organic sales growth between 0% and 3%, which, while modest, would mark a crucial return to positive growth after 3 consecutive years of painful declines. Getting back in the black. They also anticipate rebuilding operating profitability, targeting an adjusted operating margin of 9.4% to 9.9%. This isn't just about sales, it's about making the entire operation profitable again. Key growth drivers for this include a mid-single-digit return to growth in mainland China, a modest return to growth in global travel retail, and low single-digit growth in other markets. Interestingly, they are placing particular emphasis on double-digit growth in emerging markets like India, Brazil, the Philippines, and Mexico, recognizing these as new engines for future expansion, looking beyond the traditional powerhouses. However, not all markets are turning around as quickly, and it's important to acknowledge the ongoing headwinds. It's not all smooth sailing. Europe, for example, remains more concerning, with sequential slowing in prestige beauty, especially in key markets like France and Germany, largely due to subdued consumer sentiment and broader economic uncertainty there. Additionally, tariffs are expected to impact fiscal 2026 profitability by approximately $100 million, net of mitigation strategies, adding another layer of complexity. The margin strategy is designed to achieve gross margin that is flat to positive despite these tariff headwinds. With most of the operating margin improvement coming from reducing non-consumer-facing SG&A expenses through rigorous outsourcing, procurement efficiencies, and employee cost reductions, all part of the PRGP. They are explicitly committed to reinvesting these PRGP savings back into consumer-facing initiatives to fuel that crucial growth. It's about funding the future. On pricing, the company is embedding low single-digit price increases across much of its portfolio, but also strategically reducing prices on some products, and tailoring innovation to specific price points where growth is happening, demonstrating a more nuanced, market-responsive approach. Net cash flows from operating activities are projected to be between $1.0 billion and $1.1 billion, a slight decline from FY25, primarily due to higher restructuring payments expected to peak in FY26 as the PRGP runs its course. Capital expenditures are also being optimized to approximately 4% of projected sales, prioritizing consumer-facing investments over the fixed assets that previously led to overcapacity. This shows a very detailed, granular plan for financial recovery, focusing on efficiency and smart reinvestment.
So, what does this all mean for you, our discerning listener, whether you're a potential investor, a beauty industry observer, or simply a curious mind? It's a classic turnaround bet, isn't it? One of the most compelling narratives in finance. Michael Burry's interest, for instance, stems from the fact that the stock has been so severely hammered, offering a deep value play where he can bet on a significant recovery from this beaten-down valuation. Analyst valuations vary widely, with some seeing a price target of $120, implying a staggering 100% plus upside from its recent lows. Huge potential if they pull it off. Others estimate intrinsic values from maybe $31.95 for a slow recovery scenario to $39.35 for a quicker recovery buoyed by successful acquisitions. They might recommend buying between $34.25 and $41.89 with a much higher long-term target, suggesting a strong asymmetry of risk and reward. This wide range itself highlights the high-risk, high-reward nature of this particular turnaround bet.
And this raises an important question. How likely are turnarounds of this scale to truly succeed? Statistically, it's tough. As one study by Michael Mauboussin showed, the odds are often stacked against them. High-performing companies tend to stay high-performing, and low-performing companies rarely make the leap to become top-tier winners. However, if you can identify one of the few companies that will successfully turn around, the payoff can be substantial, precisely because the market discounts them so heavily. David Shea, for example, rates it a moderate to strong buy, emphasizing the asymmetry of their strong brand portfolio and the long-term potential if they get their crap together, as he colorfully put it. The risks are still significant: undeniably fierce competition, the permanent impact of the Daigou clampdown, the relatively high debt load, and ongoing geopolitical instability in key markets. But the foundational strengths of the brand, its legacy, and its loyal customer base remain. The key is whether the new strategy under fresh leadership can truly overcome these structural challenges and ingrained operational hurdles to reinvent itself for the next generation of beauty consumers. And, while expanding into TikTok Shop and Amazon certainly broadens reach and captures new demographics, it does beg the question, does it risk diluting the very prestige image that Estée Lauder has spent decades building? Is there an inherent tension between mass digital distribution and luxury exclusivity that they need to navigate incredibly carefully to ensure they don't lose the essence of what made them iconic in the first place? It's a fine line to walk.
What a journey. From its origins in Josephine Esther Menz's kitchen, driven by an almost singular vision of personalized beauty, to a global powerhouse that defined luxury for generations. Estée Lauder's story is a testament to the enduring power of brand building and strategic growth.
but it's also a powerful, almost cautionary reminder that even the most prestigious empires can face unprecedented challenges when global markets shift dramatically. Consumer behaviors evolve at lightning speed, and internal dynamics falter under pressure. We've seen the perfect storm that knocked them down, stripping away billions in market value, and now the methodical, multifaceted plan that aims to bring them back. It's a deep dive into the fascinating tension between proven brand strength and the formidable challenges of structural shifts and execution in a truly modern marketplace.
Indeed. The company's new leadership is laser-focused on growth, reinvesting heavily in consumer-facing initiatives, accelerating innovation, and adapting to new distribution channels, all while implementing tough cost-cutting measures. Early results show promise, with market share gains in key regions and an anticipated return to positive sales growth in fiscal 2026. However, the path ahead is fraught with ongoing market volatility, relentless competitive pressures, and the sheer difficulty of changing a company's deep-seated operational DNA. It makes you wonder, doesn't it? In this era of hyper-personalization, social media influence, and a demand for clean beauty and transparency, can a company founded on a very traditional, almost aspirational idea of prestige truly adapt quickly enough without losing the very essence of what made it iconic? The question for you, our discerning listener, remains. Can a company once defined by its founder's personal touch and market-leading strategies truly reinvent its core in a rapidly evolving global landscape? Or is the past too heavy a burden for even the most prestigious beauty empire to shed? What truly defines prestige in a world where consumers increasingly prioritize functionality and authenticity over traditional brand loyalty?
A fascinating thought to mull over as you consider your next beauty purchase. We hope this deep dive into Estée Lauder has given you a shortcut to being well-informed and sparked some aha moments about the intricate world of global business and brand resilience. Until next time, keep digging for those nuggets of knowledge.